Good afternoon. It's Peter Klein, Chief Investment Officer and co-founder of ALINE Wealth, with you this afternoon, the 24th of March, 2022. Good afternoon, and thank you for joining us today for what will be a very quick conversation, a discussion about the case for investing when we find ourselves, as we're finding ourselves today, in the world of inflation. And that's not a world we've been in. Many of us investors who've been around for the last 25 years barely have seen any kind of inflationary environment. So I thought this primer to discuss how we see the case for investing with inflation next to us or with us. How do we do it? How do we navigate? How do we best balance the portfolio? How do we provide our clients with the roadmap, right? The roadmap to get them through this period of inflationary pressures, which are substantial. Okay, let me proceed here to the first slide. Framing our position. Inflation, been dormant for decades, largely due to globalization, due in many ways due to emerging markets, the production being outsourced, and the fact that we've had a technology revolution, which also reduced costs for production. So, and of course, that bond market has been the big rally over the last 30 years, and perhaps that's over. I think it is. And so, how do investors navigate these waters? And inflation, folks, lest you've forgotten your economics 101, is a pervasive animal eating away at your investment returns. Dare I say it's a cancer that will eat away the returns that we work so hard to glean in your investment portfolios. So we have to be mindful of it. We have to make sure we are working alongside a strategy to embrace and to make sure we make real returns, that is returns above inflation, to provide our clients with the glide path for their financial success as we help them through their financial planning. What should a diversified investor, how should they allocate during this inflationary backdrop? How do resource companies, right, or real assets, energy companies and commodity-based companies, how do they provide an opportunity, or do they, in this environment? And finally, how about the value style of investing? Can that be an opportunity? We'll unpack that as well. So here is energy inflation. As you could see, I was out in the conference 2 weeks ago out in Los Angeles. I was really shocked to find the substantial costs of oil there, and then gasoline, $6 a gallon. Not much of that is taxes, I understand, but still, we're seeing higher prices for gasoline. That's something every consumers see every day. And so, like food, like energy, it becomes, and it builds, right? So then the companies that many industries use petroleum in their output and their production, that's going to cause them to have increased costs that they then have to pass along. And this is what becomes the pervasive feedback loop that is inflation, is that companies need to therefore increase their costs because of the costs that they're getting from raw materials are going up, and there you have it. So and then of course wage inflation. I read something that Taco Bell is now offering their cashiers $20 an hour. That seems real interesting to me. So wage inflation, and mind you, that doesn't come down so quickly. Sure, energy and food will be volatile, but wage inflation is not volatile, right? So it's going to get to a level, and that's going to stay at that level, and that has implications for margins and for operating margins and profit margins. Here is consumer inflation as indicated by the Consumer Price Index. Massive jump. And we knew this was coming because back at this time, we had the huge 26% increase in money supply. And I said at the time, well, you have to have inflation. It just has to happen. And now we're seeing the bond market adjust for that. We're at a 2.25 plus on a 10-year. So these have implications that we need to be very mindful of. This is not the circumstance of yesteryear, the last 15 years, or maybe the last 12, whereby you just threw a dart against the wall and you buy this momentum of that index and off it went. Not the case today. We've got to be a bit more active and research oriented in order to combat this new environment. And unless you don't realize that there are risks to a recession, as I just said, with margins contracting and wage inflation and such. Yes, as a matter of fact, it's happened. Is it every time we've gone above a certain level in oil, and we've done that thus far this year, we've had a recession. So there's a very good chance that we might be in that zone. Clearly, if we get even higher on the oil price, we'll see that. But the point is that there are substantial risks right now, and we've got to be mindful of them. But we also have to be able to have a playbook on how to best navigate these waters on the alpha side. In other words, the return generating side. We call that alpha. Okay, so capital allocation in an inflationary environment. What are we to do? Right? That's the question. All right. This is not going to come to any surprise to any of you, but you've got to stay balanced and diversified. This notion of taking excessive risks into one industry or one sector or one company is so yesteryear. That is not the way we want to play this market. There's too much going on, and it's too volatile to do that. Sure, we want to overweight. I'm all for that. We'll discuss it in a moment. But we want to be mindful of the risks that are associated with going too far into one sector or one industry and one mentality. Okay, we need to remain balanced. Dry powder, cash. I know that's a dirty word these days when it comes to looking at inflation. People don't want to keep cash that's dwindling away from their from their purchasing power. I get that. In the same token, it's the only asset that doesn't go down. Number two, while it has up to now been a zero returning asset, that very well may be changing as interest rates go higher. Although we got a long way to go for it to be anything consequential. And then, the idea number three is it's a font of opportunity, right? When you have volatility brought on because we're in this new regime of higher interest rates and higher inflation, you're going to have volatility. How does one exact opportunities when you have no capital at your disposal to do that? So in our thinking at Align Wealth, we want to have this font of opportunity, ergo cash, available to us. Yes, it's a drag over time on portfolios, but we think that the ballast opportunity, the safety value there, plus the font of opportunity that can come from it outweighs any kind of inflationary drag or drag to the portfolio performance. Clearly, we're going to underweight fixed income dramatically. I think bonds are game over from my opinion, and the only thing I'd be looking at there would be ultra safe, ultra short term, or Treasury inflation protected securities. Overweight real assets. You want to overweight the resource companies, the energy companies, and the commodity companies and the like. And you also want to overweight value. And underweight, by the way, high multiple growth. Because if interest rates go up, the terminal value you get discounting back those cash flows on growth become minimized. So we'll get into that in a moment as well. So just quickly, why value? It's extremely cheap, underperforming for years, and now I think it's its time in the sun. And you could see that here, where you had value outperforming, and here comes growth outperforming, then value outperforming, and here's the huge growth run we've had since the great financial crisis. Why? Because interest rates were zero. And when rates go down, growth goes up because, again, it's the mathematical discounting of the cash flows. So the key there is that's now changed. And so because it's changed, we now have value outperforming growth. And we think that's going to happen going forward. And here's a year by year, and you could actually see that year by year how the value outperformed, and then growth is outperformed here. And so we think it's now the value time, and this is essentially growth stocks being extremely expensive. So we don't want to be putting capital to work there. Again, there's idiosyncratic one-off opportunities and themes that we're still very focused on innovation. We just don't want to pay up for them. We want to wait for multiples to collapse a bit and contract a bit to allow us the opportunity to go into these companies and not pay up. I mean, the wind had been previously at our backs. We had low interest rates. That's not the case any longer. And I think we're going to continue to see interest rates go up, which has implications. And this will show you how value performed better than growth over the course of the last, this is 1974. And you can see that now we think that value is poised after a long desert, of underperformance. We believe that value is now, and when it does outperform, it usually does so considerably, as you could see in these graphs. So we think the runway is robust and opportunistic. Thank you for your time and for your your consideration working with us at Align Wealth. We are engaged in your best interests. That comes first and second and third at Align Wealth. And we want to make sure you know how we're thinking about the markets and how we're thinking about allocation and what our work is showing us and what our work will then mean for you and for your plan and for your portfolio. Please reach out to us with any questions or comments or concerns, and we'll double our efforts to go over your financial plan and estate plan and make sure we've gotten every scenario reviewed to make you feel comfortable about the future. I know it's hard. I know it's difficult these days. Stay well, stay healthy. We're here for you. Thanks again.